ai trồng cây, người đó có tiếng hát. Trên vòng cây, trên vòng cây.
Hey!
What are you doing? I'm dreaming about one husband and two children.
Oh, don't mind about that. But I have a shock news. Do you want to know?
Oh, which news? Good news.
Lee Min-ho is coming to our town.
Oh, he is my husband in Sunday.
Yes.
But how does the ticket cost?
Oh, it's cheap. Only 3 million dong.
Oh, in my opinion, it's so expensive. I'm trying to save one piece, but I'm afraid the price will be dropped into next because of the storm. So what should I do?
I have a good idea. I know a friend who is a commodity broker. Do you want to come with me?
Oh, okay.
Yeah.
Hi.
Oh, hello.
Are you the broker, right?
Oh, yes, I am.
Yeah.
Oh, sit down, please.
Oh, thank you.
Oh, how can I help you?
I want to sell 2 tons pumpkins after 2 months at the price 3 million.
Oh, I understand. So you have to enter into the royalties contract. I will introduce you a little bit about this. Okay.
Our group classifies some information about derivative products. What is derivatives products? A derivative security is a financial instrument whose value depends on, or is derived from some underlying security. The nature of derivatives products is determining future prices at current time, occurring when there is a price movement, unforeseeing, investors do not foresee the same results. The purpose of derivative products. Firstly, the purpose of derivative products is self-insurance or hedging. Using derivatives for the objective of minimizing risk in the physical market. Self-insurance or hedging is the act of a person investing in a derivative market in order to reduce the risk of price fluctuations in the foreign exchange market that it can eliminate the risk of price fluctuations in the future. The derivative tool is the most popular tool in the field of hedging. Secondly, the purpose of derivative products is speculating. Speculating on derivatives market is motivated by profit, rather than a desire to mitigate risk. Speculating is the most common market activity in the derivative market. This is a risky activity that investors participate in. Speculating activity involves buying any financial instrument or asset that an investor speculates will be of significant future value. Speculating is driven by an engine capable of making high profits in the future. Next, we get information about different types of derivative products and their risks: forwards, futures, options and swaps. The first derivative product is forwards. These financial contracts obligate the buyers to purchase an asset at a pre-agreed price on a specified future date. Forwards are customized contracts and they are not traded everywhere. So what are the risks of forwards? Counterparty risks are a kind of credit risk in that the buyer or seller may not be able to live up to the obligations outlined in the contract. If one party of the contract becomes insolvent, the other party may have no recourse and could lose the value of its position. Once created, the parties in a forward contract can offset their position with other counterparties. The next derivative product is future. These financial contracts obligate the buyers to purchase an asset at a pre-agreed price on a specified future date. Futures are traded on the exchange, as the clearinghouse and closing out the position. There are 2 major types of participants in futures and forward markets: hedgers and speculators. Hedgers try to reduce price risk inherent in their balance sheets or future business dealings by guaranteeing buying or selling prices for closely related future contracts. Speculators take risks in the futures markets, They are willing to enter a futures transaction in hopes that the market price moves in a favorable direction. The risk of future is investors have a risk that they can lose more than the initial margin amount since futures use leverage. Investing in a futures contract might cause a company that hedged to miss out on favorable price movements. Margin can be a double-edged sword, meaning gains are amplified but so too are losses. The third derivative product is options. Options provide the buyer of the contracts the right but not the obligation to purchase or sell the underlying asset at a predetermined price. There are two kinds of options, call and put. Call options give the buyer the right, but not obligation, to buy a security or futures contract at the strike price. The writer of a call agrees to sell the security or futures contract at the strike price if the buyer exercises the option. Put options give the buyer the right, but not obligation, to sell a security or futures contract at the strike price. The writer of a put agrees to buy the security, or futures contract, for the strike price if the buyer exercises the option. The risk of options is in a falling market. The put option seller may be forced to buy the asset at the higher strike price than they would normally pay in the market. The call option writer faces infinite risk if the stock's price rises significantly and they are forced to buy shares at a high price. Option buyers must pay an upfront premium to the writers of the option. The last derivative products is swaps. They are derivative contracts that allow the exchange of cash flows between two parties. The most popular types of swaps are interest rate swaps, commodity swaps and currency swaps. Interest swaps. Definition: an interest rate swap is an arrangement whereby one party exchanges one set of interest payments for another. The provisions of an interest rate swap include the notional principal value to which the interest rates are applied to determine the interest payments involved, the fixed interest rate, the lifetime of the swap, the formula and type of index used to determine the floating rate, the frequency of payments, such as every 6 months or every year. Currency swaps. Definition: arrangements whereby currencies are exchanged at specified exchange rates and at specified intervals. Character: currency swaps are commonly used by firms to hedge their exposure to exchange rate fluctuations. The risk of swaps is swaps has interest rate risk because interest rates do not always move as expected. The holder of the fixed rate risks the floating interest rate going higher, thereby losing interest that it otherwise would have received. The other main risk associated with swaps is counterparty risk. This is the risk that the counterparty to a swap will default and be unable to meet its obligations under the terms of the swap agreement. Thank you for listening.